You think the financial system is designed to help you win. Wrong. It is designed, quite specifically, to separate you from your money.
It really is.
It's an engine built for the house, not for the player. But what if I told you there's a specific cheat code, a distinct structural advantage used by the world's billionaires? We're talking Ray Dalio, Carl Icahn, Warren Buffett. I mean, these guys, they don't just work harder than you. They use a machine where money works for them while they sleep.
And that's the key.
96% of the population gets this completely wrong. They trade time for money until they die. Today, we fix that.
Welcome to the Deep Dive. This is the Success Talk podcast, and we are so glad you're here with us today.
We're excited for this one.
Yeah, because today we are stripping away all the noise. We are not talking about skipping your morning latte to save, $4.
Well, that's scarcity thinking. That's small ball.
It is. We are looking at the macro strategy, the psychology, and the mathematics of mastering the game of money.
The big picture.
We are deconstructing the massive work of Tony Robbins, Money. Master the game, and specifically the insights he got from interviewing 50 of the wealthiest self-made people on the planet.
And we need to make a very specific promise right up front because we are going to go long today.
We are.
If you stay with us until the end of this deep dive, you're going to walk away with, well, the holy grail of this book. We're going to break down the exact asset allocation formula, the all seasons portfolio that Ray Dalio gave Robbins.
The one he gives to his $100 million clients.
This is the strategy designed to weather any economic storm from, hyperinflation to a deflationary depression.
It's a really bold claim, but the data, and we'll get into this, the data completely supports it. We are going to give you the actual percentages.
The whole recipe.
The whole thing. And we're going to explain why your current mutual funds are, well, mathematically almost guaranteed to underperform. But before we get to the numbers, and the numbers are critical, we have to start where Robbins starts.
Yeah.
We have to talk about the elephant in the room.
The taboo.
It is strange, isn't it? I mean, we live in a society where we overshare everything.
Oh, constantly.
We talk about our political views, our religious deconstruction, our sex lives. We put it all on social media.
But money.
Money is the last silent frontier.
It's visceral. It is so charged with shame.
Or guilt.
Or judgment.
Exactly. If you have money, you're taught to feel a little guilty, or maybe you're worried people will take it. And if you don't have it, you feel shame, you feel less than.
So we just don't talk about it.
Right. And because we don't talk about it, we don't learn. We end up relying on, folk wisdom or worse? Marketing brochures from banks?
Robbins quotes Sir Francis Bacon early in the book. Money is a good servant, but a bad master. And I know it's a cliche, but let's actually parse that for a second.
Okay.
You either master money or it masters you. There really is no middle ground. And, well, looking at the data Robbins presents, money is the master of the vast majority of the population.
The statistics are. They're genuinely terrifying. 77% of Americans report having significant financial worries.
77%. That's almost everyone.
Only 40% have any kind of plan.
And that's the gap right there. That's the whole story.
It is. We are stressed, but we are completely passive. We're worrying about the monster under the bed, but we refuse to turn on the lights to see what it actually is.
And it's not just, young people starting out who are struggling to get a foothold. The statistic that really, really hit me was about the baby boomers. The generation that supposedly had it all. 1 in 3 baby boomers has less than $1,000 saved.
Less than 1,000. That is a crisis. That isn't, I can't buy a boat. That is, I cannot survive without government assistance.
It's a complete loss of autonomy.
It is. So the first step in this deep dive, before we buy a single stock, before we even look at a single chart, is an identity shift. Robbins argues we have to move from being a consumer to being an owner.
Let's define that shift, because I think a lot of people get tripped up right here. They think, well, I own my house, I own my car, so I'm an owner.
No. In financial terms, those are liabilities, or at best, they're use assets.
Right.
Being a consumer means you are the chess piece in the economic game. You're the target of the marketing. You trade your labor for cash.
And then you immediately trade that cash for goods and services that go down in value.
Exactly. The owner, the investor, owns the companies that produce the goods. They own the debt that consumers are paying interest on.
The bank is the player. The borrower is the piece. Apple's the player. The guy waiting in line for the new iPhone is the piece.
Precisely. We need to stop trying to earn our way to wealth and start building a machine.
A money machine.
Yes, you cannot trade time for money forever. You just can't. Eventually, you run out of time, or energy, or health. You need your money to have babies, and then you need those babies to have babies.
That's the only path.
It's the only path to what Robbins calls financial freedom.
And financial freedom isn't just a buzzword here. He defines it very specifically. An income for life without working.
Which brings us to the whole methodology of the book. Robbins is famous for modeling.
Right.
He doesn't believe in reinventing the wheel. He believes that success leaves clues.
Right. If you want to bake a cake, you don't get the ingredients. You get the recipe from the best baker in town.
Of course.
But in finance, what do? We take advice from our broke brother-in-law, or we listen to what Robbins calls the financial entertainers.
The talking heads on cable news.
Financial porn, as Gene Brannigan so brilliantly calls it.
Yeah.
The guys screaming, buy, sell, crisis, boom. Their job isn't to make you rich. Their job is to keep you glued to the screen so they can sell ads for, erectile dysfunction pills and luxury cars.
That is such a crucial distinction. They are in the business of attention, not fiduciary advice.
100%.
If they told you the truth, which is buy the market and hold it for 30 years, they would have no show. Nobody watches a show about grass growing.
It's boring, but it works.
Right. So Robbins bypassed all of them. He went to the unleash the power within of finance the unicorns.
They're the best of the best.
He interviewed Paul Tudor Jones, who had, 28 consecutive years of profit.
Insane.
He interviewed Ray Dalio, who manages $160 billion. He interviewed the people who actually move the markets, not the people who just comment on them.
And one of the most interesting non-investor interviews in there was Mark Benioff.
The Salesforce founder.
Right. And this is so important because it bridges the gap between the money and the mind.
It does.
Benioff was at Oracle. He was a millionaire. He was driving the Ferrari. He had made it by every single consumer metric. But he was miserable. He felt empty.
Because money without meaning is just paper.
It's just a scorecard.
Yeah. Benioff went to a Robbins seminar, not for stock tips, but for clarity. And that psychological shift is what gave him the courage to leave Oracle and start Salesforce, which is now a, $50 billion plus titan?
It's a huge.
And it proves that psychology is the precursor to wealth.
Okay, let's dig into that.
Yeah.
Because Robbins claims success is 80% psychology and only 20% mechanics. To the analytical listener, the engineer, the coder listening to this right now, that sounds like fluff. They want the spreadsheet. They want the numbers. Why does he insist on the 80%?
Because if I give you the perfect strategy, the perfect spreadsheet, but you have a poverty mindset, you will sabotage it.
You'll find a way to lose.
You will. You will sell when the market drops because you're afraid. You'll spend the principal because you lack discipline. The 3 pillars of breakthrough he outlines are absolutely critical here.
Okay, walk us through the pillars.
Pillar 1 is strategy. You need the right map. If you're in Chicago and you want to get to New York, but you have a map of Detroit, it doesn't matter how fast you drive, you're lost.
And most people are operating with the wrong map.
Usually a map given to them by a bank trying to sell them a high-fee product.
Okay, so we need the map. That's the mechanics. That's the 20%.
Right. But pillar 2 is your story. This is your internal narrative.
When you tell yourself.
Yes, I'm not good with numbers. Investing is rigged. Rich people are evil. If that is your story, you will subconsciously repel wealth. You won't execute on the strategy because your brain is trying to keep you consistent with your own identity.
And pillar 3.
State, your physiological and emotional state. I mean, if you approach your finances from a place of anxiety, fear, or just lethargy, you make poor decisions. You have to operate from a state of determination and faith.
The book mentions Ron and Michelle, the couple from the Fiji seminar. I think this story just crystallizes the story problem perfectly.
Yes, they were successful business owners. They had the cash flow. They knew how to make money.
The offense was great.
But they never opened their financial statements. They literally let them pile up, unopened, on a desk.
It's denial.
Complete denial. Their story was that it was too complicated or too stressful. They were great at making money, but they had zero defense.
They were bleeding out.
Right. They were bleeding out because they refused to even look at the wound. They had the strategy, which was the business, but their story and their state were completely broken.
It reminds me of that insight from Sir John Templeton. When he was asked for the secret to wealth, he didn't say compound interest, he said gratitude.
Which, on the surface, sounds like a yoga bumper sticker.
It does.
But Templeton was a ruthless investor. His logic was cold and hard. When you are grateful, there is no fear. You can't be angry and grateful at the same time. You can't be fearful and grateful at the same time. And what is the number one thing that destroys investment returns?
Fear. Panic selling.
Fear. So you have to start rich in your mind. You have to operate from abundance to become rich in your wallet. If you operate from scarcity, you make scarcity-based decisions.
Which usually means selling low and buying high. The exact opposite of what you should do.
Precisely. So, okay, let's assume we've fixed the mindset. We're ready to be owners. We have the gratitude. Now we need to look at the battlefield.
Because Robbins describes the financial industry not as a partner, but as a minefield.
It's a minefield. And this brings us to the myths. And the biggest one, the one that really, really riles people up, is the $13 trillion lie.
Okay, what's the lie?
This is the core business model of the entire mutual fund industry. The lie is this. We are the experts. We can predict the future. Give us your money, pay us a fee, and we will beat the market for you.
Which sounds intuitive. I mean, if I have a toothache, I go to a dentist. If I have a lawsuit, I hire a lawyer. Experts usually yield better results. Why doesn't that apply to stock picking?
Because the market is incredibly efficient. Information travels instantly. For a fund manager to beat the market, they have to know something nobody else knows consistently for decades.
And the data shows.
The data shows they can't. 96% of actively managed mutual funds fail to beat the market, the S&P 500, over a 15-year period.
Okay, let's just pause on that for a second. A 96% failure rate.
It's staggering.
If 96% of bridges collapsed, we wouldn't drive. If 96% of planes crashed, we wouldn't fly. But we pour trillions of dollars into active funds where the manager is statistically guaranteed to lose against the benchmark.
And we pay them for the privilege of failing.
Right.
This is the fee drain. It's death by 1,000 cuts.
Okay, let's do the math on this, because people see a 1% fee or a 2% fee on a prospectus and they think it's peanuts. They think, sure, take 2%, I get to keep 98%.
It's a cognitive trap. It's a total illusion. We think 2% is small because we compare it to the principal, the 100%, but you shouldn't compare the fee to the principal.
You should compare it to the returns.
You should compare the fee to the returns.
Okay, explain that breakdown.
Okay, let's say the market returns 7% in a given year. If you are paying 3% in total fees, and that includes expense ratios, transaction costs, advisor fees, all the hidden stuff, you aren't paying 3% of your money.
Yeah.
You are giving away nearly 43% of your profit.
That is just staggering when you frame it like that. 43%.
You take 100% of the risk, you put up 100% of the capital, and the fund manager takes 43% of the upside. Regardless of whether they win or lose, they get paid even if they lose your money.
It's as they win, tails you lose.
It's the perfect business model for them.
Robbins cites the Hilton, Smith, and Demos study. It showed that for an average worker, these high fees could eat up to, $277,000 of their retirement savings.
That's a house.
It is.
That is 10 to 15 years of your retirement income just vaporized. Not because the market crashed, but because you bought the wrong product. You bought the product with the shiny brochure instead of the boring, cheap index fund.
So the expert advice is actually just a wealth transfer mechanism.
It is.
Transferring wealth from you to the brokerage house.
Correct. And that's why Warren Buffett, who is the greatest stock picker in history, says, don't pick stocks. He famously bet the hedge fund industry $1 million that a boring, low-cost S&P 500 index fund would beat a basket of elite hedge funds over 10 years.
And he won, right?
He crushed them. It wasn't even close. The index fund just sat there, paying virtually zero in fees, and it outperformed the smartest guys in the room with all their algorithms and their PhDs.
So the strategy becomes passive indexing. Don't look for the needle in the haystack, just buy the haystack.
That's it. By owning the whole market through an index fund, you eliminate the risk of picking a losing company, you eliminate the high management fees, and statistically, you beat 96% of the pros.
It's the ultimate work smarter, not harder move.
It really is.
But
And
here's the paradox. We know this. The data has been out there for years. Buy low, sell high, buy index funds. It's not a secret, yet we don't do it.
We don't.
We panic sell in 2008. We buy speculative coins at the absolute peak. Why?
Now we get to enter the realm of behavioral economics. We have to talk about the monkey experiment.
This is Shlomo Benartzi and Richard Thaler's work.
Yes, they studied a concept called loss aversion. So they took these capuchin monkeys. In scenario A, they give a monkey one apple, the monkey's happy.
Okay, makes sense.
In scenario B, they give a different monkey two apples, and then they physically take one away, leaving it with one.
So the outcome is exactly the same. The monkey has one apple.
The mathematical outcome is identical. The emotional outcome, though, is the polar opposite. The monkey who had the apple taken away went berserk,
Really?
screaming, throwing things, just furious. It felt the loss of that second apple more than it valued the asset of the one it still had.
And we are just monkeys in suits.
We are. We are hardwired to avoid pain more than we seek gain. To your primitive brain, saving money feels like losing money.
I see that.
If I tell you to put $1,000 into a 401k, your brain screams, I just lost the ability to spend $1,000 today. It registers as pain.
So relying on willpower to save is a losing strategy. You're literally fighting millions of years of evolution.
You cannot win against your own biology. You have to trick it. And that's where the Save More Tomorrow or Smart Plan comes in.
Okay, how does that hack the brain?
You don't ask people to save money today. That's the key. You ask them to commit to saving a portion of their future raises.
Ah, I see.
You say, when I get a raise next year, 50% of that raise goes automatically into my savings.
So because I don't have the money yet, I don't feel the loss. It's abstract.
Exactly. And when the raise actually comes, your take-home pay still increases, just not as much as it would have. You never see the money in your checking account, so you never feel the pain of losing it. It bypasses the amygdala completely.
Automation is the key. You have to remove the decision-making process.
You have to.
If you have to engage your willpower every 2 weeks to sit down and write a check to your savings, you will eventually fail. Life will get in the way.
But if it happens automatically, you will get rich. It's almost inevitable.
Okay, so we've shifted our mindset. We've fired the high-fee managers. We've automated our savings flow. Now comes the million-dollar question. Where do we put the money?
This is the centerpiece of the book, the asset allocation.
And Robbins didn't just want a generic 60-40 split. He went to the master. He went to Ray Dalio.
For anyone who doesn't know, Ray Dalio isn't just a rich guy. He runs Bridgewater Associates, the largest hedge fund in the world. He predicted the 2008 crisis.
His firm manages $160 billion. He's called the Steve Jobs of investing.
He is, but Dalio usually only takes clients with, what, $100 million or more?
Right, so you and I can't call him up.
No. But Robbins pestered him. He said, Ray, you have this all-weather fund that makes money in good times and bad, but it uses leverage and complex derivatives. It's not for the little guy.
He said, give me a version for the average person. Give me a version I can build at a discount brokerage with a few ETFs.
And Dalio sat down and sketched it out, the all-seasons portfolio. And to understand it, we first have to understand his philosophy of seasons. Dalio's thesis is that you cannot predict the future. Nobody knows if stock will go up or down next year. Economists are wrong almost as often as they're right.
For sure.
But we do know that economic history repeats in cycles. There are only 4 things that can happen to the economy.
The 4 seasons.
Right. Number 1, inflation. Prices go up.
Okay.
2, deflation. Prices go down.
Right.
3, rising economic growth. The boom times.
Good times.
And 4, falling economic growth. The bust or recession.
And different assets, like different seasons?
Exactly. Stocks love rising growth. They hate recession. Bonds love deflation and recession. When interest rates fall, bond prices tend to rise. And gold and commodities love inflation.
And the problem with most people's portfolios, and even the experts' portfolios, is that they are heavily weighted toward one season, rising growth.
Yes, if you just own the S&P 500, you are making a massive bet on rising growth. If growth slows or if inflation hits, you get crushed. You are biased toward one outcome.
You're not diversified.
You're not diversified by economic outcome. Dalio wanted a risk parity portfolio, a portfolio that is balanced to survive all 4 seasons equally.
Okay, let's give the listeners the numbers. This is the recipe. If you're driving, pull over. Or just check the show notes. But try to visualize this pie chart.
Okay, here's the Ray Dalio all seasons allocation for the average investor. The first slice, 30% in stocks.
That seems low. Standard advice is usually your age and bonds. So for a young person, it's often 80 or 90% stocks. Why only 30%?
Because stocks are volatile. They are the wild child of the portfolio. Dalio says stocks are about 3 times more risky than bonds.
Okay.
So when you have a 50-50 stock and bond portfolio, you actually have 95% of your risk in stocks. To balance the risk, not the dollar amount, but the risk, you have to lower the stock allocation. So 30% stocks covering the growth season.
Okay. Next slide.
40% in long-term U.S. Treasuries.
40% in bonds. And specifically long-term. That's the part people will question.
Yes, this is the controversial part for many. But long-term treasuries, we're talking 20-year plus bonds, are the anti-stock.
The parachute.
They are the parachute. When the world is ending, like in 2008, or the COVID crash investors flee to safety, they buy treasuries. When stocks crash, long-term treasuries usually spike in value.
Okay. So we have 30% stocks for growth, 40% long-term bonds for crash protection. What's next?
15% in intermediate U.S. treasuries. Think 7 to 10 year notes. These provide some yield, some income, and they're less volatile than the long-term bonds. They're like the ballast. They just keep the ship steady.
Okay. That brings us up to 85%. What's the remaining 15%?
The last 15% is your inflation hedge. It's split in two.
Okay.
7.5% in gold
Gold.
and 7.5% in a broad basket of commodities.
Why gold? I mean, isn't it just a barbarous relic, as Keynes said?
In a fiat currency system, where governments can print money at will, you need hard assets. If they print too much money, that's inflation. Stocks can struggle due to rising costs, and bonds get destroyed because interest rates usually rise to fight that inflation.
But gold holds its value.
Gold has been the store of value for 5,000 years. It zigs when the dollar zags.
And commodities, we're talking oil, wheat, corn.
Exactly. Things people actually need and consume. During high inflation periods like the 1970s, commodity prices just skyrocket. This protects your purchasing power.
So let's recap the all seasons pie.
Let's do it.
30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, and 7.5% commodities.
That's the mix. And the back testing on this is what sold Robbins on it. They looked at the last 75 years of data.
And how did it perform?
Well, it made money in roughly 85% of the years, but more importantly, let's talk about the losses, the drawdowns.
Right, the bad years.
In 2008, the S&P 500 lost about 37% that year, and over 50% from its peak to the bottom. The all seasons portfolio was down something like 3.93%.
That is the difference between a massive heart attack and a mild headache.
And that matters because of the math of recovery. If you lose 50%, you need 100% gain just to get back to break even.
Which can take years.
Years! If you lose 4%, you can make that back in a few months.
It's the tortoise and the hare. The hare, which is all stocks, runs really fast, but it crashes hard. The tortoise, the all seasons, just keeps marching forward.
It's about staying power. This portfolio allows you to sleep at night, and if you can sleep, you won't panic sell. And if you don't panic sell, you win the game.
Now, I can hear the aggressive investors listening and screaming right now. But wait, if the market goes on a 10-year bull run, this portfolio will underperform the S&P 500.
And they are 100% right. It will. You are trading maximum upside for maximum safety and consistency.
Need a trade-off.
It is. But Robbins argues that for the average person who has a job and kids and stress volatility is the enemy, most people cannot handle a 50% drop. They just can't. They will sell at the bottom. This portfolio protects you from yourself.
So it's better to get a smooth 8 or 9% return that you can actually stick with than a volatile 12% return that you abandon in a crash.
Exactly. A great strategy implies great execution. You have to be able to execute it.
Okay, so we have the map, we have the vehicle. Now we need to actually drive. Let's talk about execution, because as Robbins always says, knowledge is only potential power. Execution is mastery.
Right. Step 1 is the Freedom Fund. You need to open a separate account. This is not your spending account, and you need to set up that automatic transfer we talked about earlier.
How much should people start with?
Robbins says start where you can, but aim for a minimum of 10 to 15%. And if you think you can't live on 90% of your income, you're deluding yourself. If the government raised your taxes by 10% tomorrow, you'd complain, you'd scream, but you'd pay it. You wouldn't starve.
All right, we'll figure it out.
So treat your savings like a tax you owe to your future self. Pay yourself first.
And how do we accelerate this? Because compound interest it's really slow at the beginning. It's boring.
It is. There are 3 accelerators. Number 1, save more. And this isn't just about lattes, that's a distraction.
It's the big stuff.
It's the big structural costs. It's the car. Driving a car for 10 years instead of leasing a new one every 3 years saves literally hundreds of thousands of dollars over a lifetime when that money is invested. It's refinancing your mortgage.
Okay, number 2, earn more.
This is the law of added value.
I love this section. He shifts from investing advice to career advice.
He does. He says, don't ask for a raise, ask how you can add more value. If you add 10 times more value to your company, the money will follow. You become indispensable.
And this links back to what Mark Benioff did with his 1-1-1 model at Salesforce.
Yes. Benioff integrated philanthropy from day one. 1% of equity, 1% of product, and 1% of employee time was given to charity.
Which seems counterintuitive, right? Giving money away to get rich.
It does, but it creates an abundance mindset. It tells your psyche, I have enough to share. And that confidence fuels growth. It breaks you out of that scarcity loop.
Okay, and the third accelerator.
Reduce fees and taxes. We've already hammered on the fees. But taxes are the other big hole in the bucket. Using your 401k, your Roth IRAs. These are government-sanctioned tax shelters. If you are not maximizing them, you are volunteering to pay more taxes than you're legally required to.
And all of this just feeds the eighth wonder of the world, compound interest.
The doubling penny. If you take a penny and double it every single day for 30 days, you don't end up with $100. You don't end up with $1,000. You end up with over $5.3 million.
But the magic only happens at the very end. The curve goes vertical.
Right. On day 20, you only have about $5,000. The growth looks flat for a long, long time, and then it explodes. That's why patience is the hardest part of the game.
There's that chart in the book that shows 2 different investors. Investor A starts at age 19, invests $2,000 a year until age 27, and then stops forever. Total invested $16,000.
Okay.
Investor B starts later at age 27 and invests $2,000 a year all the way until age 65. Total invested $78,000. Who has more money at retirement?
Investor A. The one who started early and stopped.
By a lot. It breaks my brain every time I think about it.
It's the time value of money. Those first 8 years of compounding are worth more than the next 39 years of catching up.
So if you are listening to this and you're in your 20s, you are holding a lottery ticket. Do not waste it.
And if you are in your 50s, you can't afford to make big mistakes. You need the efficiency of the all-seasons portfolio. You can't risk a 50% drop now. You have to catch up through efficiency and tax savings.
We have covered a massive amount of ground today.
Laura.
We moved from consumer to owner. We exposed the active management lie. We built the all-seasons fortress. We automated the machine.
It's a complete system. But I want to circle back for a moment to the why. Tony Robbins is a billionaire. He didn't write this book to make more money.
No, he donated all the profits.
He donated all of it to feeding the hungry. He wrote it because he was angry seeing people lose their life savings in 2008.
And the goal isn't just a high score on a screen. The goal is F you money.
He calls it financial freedom. But yes, it's the ability to say no.
That's it.
The ability to do what you want, when you want, with whom you want. That is true wealth.
And if you don't build that for yourself, you are trapped in the system. You are a chess piece being moved around by your boss, the bank, and the government.
You have to become the player.
So here is the final thought I want to leave you with. It's a challenge. Most people spend more time planning their annual 2-week vacation, scrolling through TripAdvisor, comparing flight costs, than they do planning their entire financial life.
That is a painful, painful truth.
You plan your escape from your life more than you plan the life itself. Stop doing that. Take 1 hour this week. Set up the Freedom Fund. Look at the index funds. Start the machine.
If you don't build your dream, someone else will hire you to build theirs.
If this deep dive gave you clarity, do us a favor. Subscribe to the Success Talk podcast and share this specific episode with one friend, the one who keeps cash under the mattress or is still chasing meme stocks. Help them master the game.
Thanks for listening. Let's get to work. See you in the next